Hello ladies and gentlemen, thank you for tuning in to Ascending Abundance YouTube channel. My name is Pavel Sverdlin. I am a CFA CPA, not a financial advisor, so all of this is educational purpose only. I explore various ways of making more money with the money that we got, investing in stocks, crypto, real estate business, whatever comes. I just want to make more money for me and my family, to do good in the world, and to achieve financial independence at the starting step of that. So today's topic is cash. I'm getting into cash. I'm selling part of my positions. I am creating some liquidity so that I can get back into the market when the time is right. The only way to buy at the dips is to have some cash available. You either make it, like Warren Buffett was $150 billion in cash. That's because his operating companies are generating so much. Or you have to sell some of those positions so that you could have cash available to get back in. And the reason I am selling is going to be explained in a couple of minutes. First of all, let's look at the Federal Reserve balance sheet. The old saying, don't fight the Fed, still applies. The Fed is tightening. They are selling off their assets, treasuries, and mortgage-backed securities to the tune of $95 billion a month. That's going to be about $1 trillion a year. They have sold from about 9 trillion down to 8.2. They're continuing to sell. This little blip, that's the banking crisis in the March of this year, April of this year, when a few banks collapsed in the United States due to commercial mortgages and other issues. So they had to inject liquidity into the market, which kind of killed a few months of operations for them. So now this is going to continue for longer than expected. The Fed has already sold about $1 trillion, and they will continue to do so. As you can see, prior to the 2020 COVID crisis, they had about $4 trillion. Now they're at about 8. So the trillion per year, they got years to go, literally years. Even if they don't go down to 4, maybe they will go down to 5 or even 6. That gives us another year or two of sales unless something happens. But right now, don't fight the Fed. By selling those securities, they're taking cash. And that cash is getting out of the economy and therefore from financial markets, and it is slowing down everything as well as investments. We haven't seen that impacting us too much yet. This year has been good for stocks, but again, don't fight the Fed. There's been a lot of cheer that the inflation is going to get nailed, that unemployment is still great, GDP is positive. My question is, how can you have a positive GDP of 2.4% if your inflation is running at 4, 5, 6, or 7? Nominally, because you printed so much money, it looks positive. In reality, it's got to be a recession. We got to be in a real GDP negative if you take it in terms of dollar value. And that's what I believe we're in. We're in a recession. So another thing is reverse repo facility from the Fed. I know it's kind of boring. Those are the cash that is held at the Fed overnight. Various mutual funds and money market funds and whoever else wants to park their cash at the Fed, they kind of purchase treasuries from the Fed overnight, give Fed the cash, and then Fed buys back those treasuries and other securities at a nominal, small kind of interest, and gives that cash back to the banks to operate. So that cash that is sitting in those money market funds is kind of sitting on the sidelines. It's about 1.8 billion. If we extend it, it should be about 1.6, 1.7 actually, if I look at the current situation. But yeah, look, it's about 1.7, 1.8. Anyway, this is the cash that is available to purchase any kind of treasury issuance by the US government. So now the question became, would US Treasury, after lifting the debt ceiling, issue a lot of treasuries to fund US government operations? And if they do, they have to sell it somewhere. And if the Federal Reserve, as we have seen, is selling their balance sheet and the Treasury is also selling their treasuries, well, who's going to buy? Well, part of it is foreign governments, part of it is various hedge funds, mutual funds, but part of it is coming from the very own reverse repo facilities. And as you can see, there's still about 1.7 trillion of cash in there. If Treasury needs to sell $1 trillion, they can sell the trillion. This is not going to go to zero. The reverse repo is not going to be fully extinguished, but there's still an easy $1 trillion of cash sitting there waiting to be deployed if they choose to buy treasuries, which I believe they've been doing. This is why the U.S. Treasury was able to sell their issuance lately. It's because some of that money came from 2.3 trillion up here in April and May down to 1.7. That's $500 billion or $600 billion ish that was probably invested in treasuries that Janet Yellen had issued lately. And they can sell another $1 trillion. So this could continue, and it will mop up the treasuries that are sold by the Fed and the treasuries that are sold by the Treasury. Easily one more year to go, again soaking up that liquidity from the capital markets. It goes to Treasury, US government spends it, that's US spending, that's good for the economy, it's kind of stimulating, but at the same time it takes a while for that money to be spent by the government, to go back into the economy, to kind of feed into the earnings of companies and lift those share prices. That will take a while. In the meanwhile, cash flow is being mopped out of the financial system. The next thing I want to look at is the state of sort of the economy itself. Baltic Dry Index is measuring the price of shipping goods and goods, not services, goods overseas. That's your coal, that's your finished products, that's cars produced in China, traveling from Asia to United States, Europe, like those are transatlantic shipping rates. They're at the lowest end of like 2020, 2021. During COVID, when nothing was shipping and everything was stalling, that's how much the rates are. So obviously there's a lot of shipping vessels that are empty, that they're not being used. The prices have dropped. As you can see, they dropped from all the way from $4,000 and $5,000 and almost $6,000 per whatever down to $1,100. That's a huge drop. That tells us that there's a lot of underused available shipping in the real economy, in manufacturing, not Meta, not Google, not AI. This is the real deal. This is the manufacturing. Those are the goods we all consume. United States Purchasing Purchasing Managers Index, PMI, anything under 50 shows a contraction in the U.S. manufacturing economy. It's been in contraction for the good part of 2023 and then some, and it's still contracting. So the factory purchases of inventories, the factory shipments, everything is kind of contracting. People are not buying materials anymore as much as they used to. This needs to somehow catch up with the real life. Like there's got to be a drop in output, there's got to be some impact to the real economy. Look at another metric. Just today, China exports fall again, impeding the economic recovery. They fall by double digits. If you read some of those news articles, they fall by double digits. This is not exciting. That means the world trade is falling down, and that's kind of similar to what I'm saying here. So the trade is going down, manufacturing index is down in terms of the purchasing of by factories and so on. So real economy is kind of suffering. What we're not seeing is these companies and factories laying off workers yet. They're somehow holding to those workers because we're not seeing big unemployment. Unemployment in the United States is pretty stable. It's a highlight of the economy. It's wonderful. We're having a soft landing. That's what I'm hearing on TV. So I go to the U.S. Bureau of Labor Statistics, pull up this lovely chart that they show on their website, but this chart is, as beautiful as it is, requires a lot of clicking. So I went down to see the data behind the chart. You can kind of click the table, put it in Excel. I'm going to enlarge it a little bit. And this is what I'm seeing. So employment as of July, 1,000. So this is the change. So this is how many people got hired in July. Looking at the bigger numbers, I kind of highlighted in this golden kind of color. The majority is professional business services, private education and health services, leisure and hospitality, government, and a little bit of retail trade as well. So look at this closer. So percentage, like out of 100%, so these are the biggest, right? Retail trade, professional, private education and health services is actually 16%, the majority of it, and then government. Now government, I suspect they were holding off hiring because of the debt ceiling. I mean, they were running out of cash, treasury was empty, there was probably some sort of a hiring freeze for a while, so they're just catching up. This could be a big question mark. A retail trade, I mean, people are doing okay, so they're still spending, that's all right. Professional business services as well. Private education and healthcare services kind of surprised me. Leisure, sure, post-COVID, it's summertime, people are out, people are about, enjoying their life. But then I look at the total number for the year. How much did this change by? And that was an eye-opening. So retail trade, no big deal. 66,000 over the year. I mean, these guys don't make any difference. In fact, construction and manufacturing probably added more than they did. But there was a full economic recovery post-COVID, so that's not surprising. 1 million people was added by private education. Leisure and hospitality, 700, followed by the government. Well, the government is ever expanding, so no surprise there. All levels of government, if you click, all levels of government added jobs, local governments, state governments, and federal. So local is the most, federal is the least, and state is kind of in the middle there. So government added jobs, no big deal. Leisure and hospitality, so who is adding kind of jobs? Basically everyone. This is other services, this is not leisure, this is leisure. So leisure and hospitality, no surprises. People are looking at hotels and restaurants. Food services, so eating out, that's the big one, 400,000, 500,000. And then arts and entertainment, so probably concerts and such, post-COVID, no surprise. That keeps on adding. But I want to see, are they continuing to add? Like, is this an ongoing trend that they're continuing to hire? And, sorry, leisure and hospitality is here. So, and I look at as percentage of the overall hiring, 21%, that's for the last year, 13, 10, 9. So I can kind of see slowing down in leisure and hospitality hiring. It's kind of evident. Government, I think, is going to slow down hiring as well, post that debt ceiling increase. Private education and health services, I'm surprised. I wanted to see what that is about. So really, there is no education. It's really healthcare in general, ambulatory health services, hospitals, nursing homes, nursing facilities, home care services, and then social assistance and individual family services. I would say this is government. Really, like, this is not a business. This is, to me, a government service, very much needed, very much required, but this thing is not a real private sector to me. Maybe I'm wrong on this. So lots of healthcare. Population in the United States and worldwide is aging. People need medical assistance. This is not going to slow down, and in fact we see that in the past 12 months, 6, 3, and 1 month, the proportion of people hired out of the 100% has actually been mostly in here, right? Like, it's increasing and growing like crazy. Healthcare is not going to stop, and quite a bit of it is going to be on government assistance, Medicare, Medicaid, all kinds of insurance. People are aging, so it's not hiring by the government, but a lot of it is paid by insurance and government. If you agree with that, please leave a comment. So those are kind of the biggest buckets that we look at. Professional business services, as much as they are hiring, they're like up here as well. But they kind of slow down. See, as a proportion for the past months, they're actually down, and they kind of been, on a downtrend lately as well. So out of everything, it's just the healthcare that is keeping everything afloat. And I argue that when the population is aging, and despite the immigration, it's still going to continue aging and require more and more spending on health. That area is going to continue to benefit, and that's why I'm keeping my XLV, and I'm keeping my Johnson & Johnson, and I'm keeping my HSA, and a few other stocks that I own in this sector. I'm not going to sell. These are wonderful wonderful cyclical, not non-cyclical businesses. They're just gonna secular. They're gonna be secular businesses that keep on growing. So with the economy, in my view, kind of hinging on healthcare and people to continue to spend and hire on leisure and hospitality, meanwhile economy is slowing. Meanwhile, the jobs are, again, leisure and hospitality is not well paid. Government is typically not the best paid. The information services, though, we have seen a contraction. That's where the most paid professionals are. So the purchasing power of those of net between this loss of 28,000 and this gain, let's say, of 125 or something, that's going to be more significant. Leisure and hospitality, despite hiring so many people, they're probably not paying as much to those folks in hotels and food places as Google and Meta and Facebook could have been paying their people that they laid off. So all in all, I'm seeing signs of slowdown. I'm seeing Federal Reserve tightening. Interest rates are high. That is going to take a bite out of retail trade and any other trade because people have to come up with more and more cash for their mortgages and credit cards. Inflation is slowing. I didn't bring up inflation here, but inflation is slowing. So I am expecting a drop in stocks. In the meanwhile, if we look at TradingView, just real quick at the not Bitcoin, but let's say SPY. If you look at S&P 500, it had a really nice run. Let's remove the Bitcoin out of here. S&P 500 had a very nice run. If we add NASDAQ, that had a super nice run, and both of them, why is it showing down? I don't know. Is this the right SPY? Is this the right SPY1? I have no idea what that is. Let's look at QQQ NASDAQ, please. There you go. I don't know what that thing is. Yeah, that is really strange. Looking at this here alone, maybe that's why. Yeah, so looking at this here alone, S&P 500 is 20%-ish up, NASDAQ 40% up, crypto is going to be even more up, so here you go. Like, let's say if we look from December, 20% SPY rise, QQQ 40% rise. Too good to be continuing to rise. There's a little bit of a dip. There's a little bit of a dip here. I'm not calling for a major crash. I don't think it's just gonna go through the floor, but I have a hard time understanding why would it continue rising, why in the current environment of tightening, liquidity going down, factory orders going down, China slowing down, everything is down, yet stocks already up. They're up by more than, say, 1 standard deviation from the mean when you look at their PE ratios. NASDAQ is 1.5-ish, 1.1 standard deviations above its own mean or median for PE. S&P 500 is 2 or 3 standard deviations above its mean and median for PE ratios. I just don't see those earnings and PE ratios expanding further. So I'm allocating 15 to 20% cash. I'm going to take off some winners from the table. I'm going to sell some of those positions in my tax advantages account, TFSA and RRSP in Canada. That would have been my 401k, I guess, or Roth IRA in the United States. And keeping that cash for more NASDAQ investments and more Bitcoin investments when the time is right. Maybe timing the market is going to bite me, maybe it's going to continue growing, so be it. I'm still going to be 80% invested, and if I find that the market conditions are still conducive to continuous investments, well, maybe I'll lose out on part of the gain, go back into the market, lose a little bit, and then continue making those gains going forward for years to come. Or maybe I'm going to have some cash on the sidelines until there's a drop of, say, 15%, very possible, and then I go back in and make my 15%. So let's see, keep me honest. This video is going to be out there. If anybody wants to point to it and say that I was wrong, that'll be easy. And if I'm right, then I'll be bragging about it for years to come, or hopefully not. Either way, let me know what you think. Do these kind of arguments make sense to you. Look forward to hearing back from you, and thank you very much for listening. Do hit the like button, do hit the subscribe button, leave me some comments, suggestions, reach out for any kind of business deals. Happy to chat on the phone. Either way, talk to you.